All right, today I am talking about tax loss harvesting. This is a term that you hear thrown around at the end of the year by a lot of investors, and a lot of people I find don't really know what it means. So we're basically just going to explain kind of what it is and when it's relevant. So this is only relevant for brokerage accounts. So if you have like an IRA, 401k, or anything like that, anything that's tax deferred, completely ignore tax loss harvesting. It's not relevant for anything that's tax deferred already. This is relevant for like if you have a stock trading account that you operate individually, or you have a, basically taxable brokerage account through a financial advisor. That's when tax loss harvesting makes sense. So here's what it is. Every year you pay tax on your net capital gains. A capital gain is when you liquidate a stock or a mutual fund. So you actually have to sell the position to recognize a capital gain. Your stuff can increase in market value all we want and not have any tax implications until you actually liquidate that position. So this is mostly for accounts that you've liquidated some positions, you have some gains that you're going to pay tax on. It's taking a look at your account at the end of the year and saying, okay, we recognized maybe $10,000 in capital gains. So we have these other positions that we're still kind of waiting on them to be profitable, but for right now they've decreased in market value. Why don't we liquidate those and recognize a loss? Because if we don't sell it, again, it's unrealized, so it doesn't end up on our tax return as a loss. So why don't we sell those positions before the end of the year to offset those capital gains that we had earlier in the year? The other thing that it can offset is what's called capital gains distributions, which is like capital gains from mutual funds that you really don't have any control over. They're taxed basically whether or not you liquidate the position. It's just spun off by the mutual fund. So it's looking at all that whole picture and saying, I'm going to liquidate these positions just so I can offset my capital gain income. And so a lot of people will do it towards the end of the year. There's a couple of things though that you need to be careful of, some common mistakes that I see. One is you can't sell a position and then re-enter that same position within 60 days. Otherwise it'll disallow the loss. It's called a wash sale. So if I'm holding like Amazon stock and it's way down towards the end of the year and I'm like, well, I still want to invest in Amazon, but I want to sell this right now, recognize this loss, and then I'll hop back in at the same price after the year is over, and then I'll still be invested, but I'll have recognized a tax loss. The IRS doesn't allow that because you basically re-entered a substantially similar position within 60 days. So got to be careful of that. And then the other thing is just, communication between accountants and financial advisors. That's the biggest shortfall that I see in this area, is that a lot of times financial advisors will basically be operating under the assumption that they need to offset every single gain that they've had in the account. And sometimes they overdo it because maybe the taxpayer has another investment somewhere else that they already have losses, or maybe they sold, an equity stake in a small company and have a large capital loss there or something like that. And they didn't need to do all this harvesting. So what ends up happening is they're kind of operating inefficiently. They're trading a lot more strictly for purposes of offsetting gains, when maybe the reality is they didn't need to, and they could have held on to some of those positions that may have been more beneficial for the individual. So that's kind of the two biggest shortfalls, but it's a legitimate strategy. It can help offset tax liability. It's not something that's real common these last couple of years because the market's been kind of crap for most people. So it's not a widely used strategy in years like this, where there's maybe some losses across a lot of accounts. But either way, still something worth considering towards the end of the year when you're doing your tax planning.